This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello and welcome to the AJ Bell Money and Markets podcast. I'm Charlene Young and joining me today is Tom Sieber. Hi Tom.
Hi Charlene. Yeah, a week is a long time in podcasting. Since our last episode, we've seen another tariff flip-flop for President Trump, an update from the IMF on UK PLC, and news on falling energy prices.
Dan Coatsworth is here this week to talk to Ian Lance, co-manager of Temple Bar Investment Trust, about the UK stock market losing its unloved status, takeover talks surrounding BP, and where he is seeing good value now. And I've sat down with financial planner and meaningful money finder Pete Matthew to talk about his new book. It's all about helping people to navigate the tricky world of retirement planning and take control of their money.
And I'll also be bringing us all up to speed with news from Tesla in Europe and Games Workshop.
So let's kick things off with the big global political talking point, Donald Trump's latest twist on tariffs. It's a bit of a U-turn, isn't it? 1 minute it's kind of America first, and the next he's had a very nice telephone chat. Sounds a bit familiar.
Yeah, you're right, Charlene. So Trump has rode back from a threat last week to impose 50% tariffs on European goods from the 1st of June. And as you say, the catalyst for that was a phone call, this time with the President of the European Commission, Ursula von der Leyen. And those levies have now been pushed back to 9th of July to allow time for talks to progress. So I guess with a lot of these U-turns that we've seen from Trump, it looks like, you know, the starting position is often just a negotiating tactic. Yeah. The problem, I suppose, for Trump is if the other side knows that you're likely to give in eventually, then that sort of approach might lose some of its effectiveness. And I did see that it's led to the coining of a new acronym, so TACO, or Trump always chickens out, which that might be unfair, but it reflects a belief in the market that the administration will always retreat, essentially, from any kind of fully blown trade war. And that's restored a bit of risk appetite in the market. So like the UK, the US market was closed on Monday for a public holiday for Memorial Day, but it enjoyed really strong gains when trading resumed yesterday. We're recording this on Wednesday, the 28th of May, so on the 27th of May. And it was also helped by a decent reading for US consumer confidence from the conference boards. So this index of consumer confidence rebounded after declining for 5 straight months to a reading of 98, which compared with 85.7 in April. And that was the lowest level sort of seen since the height of the pandemic. So clearly, you know, US households are feeling a little bit more positive about life. And I think it seems as if the catalyst for that was a previous tariff U-turn. So this time when Trump agreed to delay tariffs on China.
Yes, indeed. So on the 27th as well, we got some updated growth forecasts from the IMF. And that showed that they expect the UK economy to grow by 1.2% this year, rising to 1.4% in 2026. Now, the IMF says that, you know, we've had an economic recovery underway after a boost in the first 3 months of the year, thanks to consumer spending and business investing. So some good news for Chancellor Rachel Reeves is, you know, they've effectively given her scope for a little bit more wiggle or wriggle room on her fiscal rules. But, you know, at the moment, kind of even just a little nudge here or there in those OBR forecasts can wipe out that kind of infamous headroom. The IMF also suggests that we move to just one forecast from the OBR each year, I should say, rather than the current twice yearly forecasts that we get, with some changes to how this is all kind of communicated and kind of some protocols in place to prevent sort of minor breaches of the rules forcing her hand in terms of tax increases or spending cuts. You know, as we've heard many a time, she says that these rules are non-negotiable. You know, but on the flip side of the coin, the IMF, you know, still warns that there might be a need to hike taxes or slash spending if kind of economic shocks arise. So sort of giving with one hand, a little bit of wriggle room, but a warning with the other. And, as I've mentioned, they've had that warning that she might need to break those rules. And it's worth kind of mentioning as well, those first 3 months of the year that are cited in the forecast as kind of being behind that kind of buoyancy, if you like, they came before that roller coaster of April, the tariff talk, the price hikes, employer NI changes that came with it. And, another regular warning, this isn't going to be news to anyone, but forecasts are not flawless, of course. And, especially when you consider this is not long after a downgrade from the very same IMF for UK growth not that long ago. But we love a bit of potential good news, don't we?
Yeah, we'll take it where we can, I think. Yeah, definitely. It suggests the UK is maybe starting to find its footing a little bit again. We've seen inflation stabilise, a little bit more business confidence out there, and also lower energy costs.
Yes, indeed. Sort of speaking of energy, last Friday, the news was out that the energy price cap is coming down by 7%. So, potentially a welcome change for households feeling the pinch, but obviously that cap isn't what everybody automatically pays. In terms of how that might affect the kind of average bill, Ofgem, the regulator, is saying the typical bill should drop by around about £11 per month from July, and that cap is through until September. So it's the first cut this year, so that's, not get too excited. Bills are still much higher than they were pre cost of living crisis. To give you a bit of an idea, it brings costs back to where they were in January this year. Now, the energy regulator, as I mentioned, Ofgem, has also reiterated calls for people to consider fixing, perhaps for a year, as there are some decent deals out there in their eyes. Particularly if you value kind of a bit of certainty over your prices for the next 12 months. Over a third of bill payers are on a fixed deal now, so that's more than double the proportion from a year ago. And that's largely down thanks to more offers on the table from energy providers.
True. And while prices are falling, there's talk of the government reconsidering who gets the winter fuel payment. The Prime Minister says he wants more people to qualify for it, but he hasn't offered much detail on how and exactly when that might happen.
Yes, I mean, it's not just Trump who likes a U-turn. I mean, I can't stop thinking about that acronym. It's too many in financial services, but he will absolutely hate it, won't he? But kind of back to back to home, and our own Prime Minister, as you say, looks to kind of conceded that some of Labour's performance in recent local elections might be down to this pensioner benefit. And, it's not even been a year since Rachel Reeves announced that the winter fuel payment would be restricted to those who are eligible for pension credit, so those on the lowest income over state pension age, rather than it being a universal payment. We don't know the detail yet, but are we back looking at how to means test it again, but without the kind of admin and red tape absolute nightmare that full means testing brings? Now, one suggestion that has been floated out over the past few days, and has been endorsed by a former Labour Chancellor, is perhaps bringing the winter fuel payment into the self-assessment system. So clawing it back for pensioners who pay higher rate tax, for example. So kind of back through tax returns. Now, it was Ed Balls that came out and suggested that, perhaps this could work slightly like the way that child benefit is clawed back for people on incomes over £60,000 now. And that's using something called the high income child benefit charge. Now, frankly, that was a complete disaster in the early years in terms of administration. And it would also involve bringing a whole host of pensioners into self-assessment just when HMRC is trying to take people out of that system. It can be hideously complicated. It is definitely not the kind of silver bullet that was kind of mooted by Ed Balls. I was quite surprised by that suggestion. And, also, how is it going to be paid for? And a Freedom of Information request I saw recently showed that there were over 7 million pensioners paying basic rate tax, so your 20% level, and 1 million pensioners, I should say, paying tax at 40% or above. If you take that 7 million, kind of bringing them back into the winter fuel payment possibility, £200 to £300 for each of them is going to effectively dig another fiscal black hole. Now, that's not to say, obviously, we need to protect the most vulnerable in society. I'm absolutely not, disagreeing with that at all. But how to do it, I really think, it's a view we hold here that it requires a kind of a long-term plan for reform. So not kicking state pension reform, triple lock, and later life spending reviews and long-term care reviews into that kind of long grass, and really thinking about sustainable ways to support pensioners in later life. Look, we've not seen anyone brave enough to tackle this for many years now. I'm not sure it's going to be coming around the corner, but yeah, I thought it was just kind of worth running through kind of some of those changes we've seen filter through to the press recently.
Yeah, I mean, I think the problem is that politicians operate on quite sort of short-term electoral kind of timelines, don't they? And, you know, there's no incentive really for them to tackle those kind of problems because they're big problems and like you said, they take a long time to fix.
Yeah, we've seen successive administrations kind of avoid it. I just, with the announcement in July, the shock, that did come with that. I think a lot of people were surprised at the time, the doubling down. No, we're absolutely doing it. It's the right thing to do for the UK's finances. Of course, it's the right thing to do to kind of look after the most vulnerable. But yeah, it's a tricky one, and we've seen various reviews sort of paused or kicked into the long grass. So yeah, I'm not expecting the current Prime Minister and Chancellor to solve all these problems, but yeah, I was quite surprised not even a year in that a huge retreat might be on the cards, but it might not. Yeah. So right, politics to one side. Well, actually, in the UK at least, back across to the US, and it's not all plain sailing for Elon Musk's Tesla. Now, the electric vehicle market is proving a tricky space, even for Elon himself.
Yeah, that's right. I don't know if you saw any footage of the latest SpaceX failure with that rocket spinning out of control, but it's not a bad visual metaphor for Musk's other main venture, Tesla, in some respects. So the electric vehicle maker had a bit of a rally after its quarterly results because they weren't quite as terrible as some people had feared. And also Musk confirmed he was going to return more of his attention back to Tesla and away from his activities with the Trump administration. And the hope being that, that would steer the business back on course. But there are signs this week that the company's competitive position, particularly outside the US, is looking quite challenged. So one of those, hinted in the intro, relates to Europe, but also at the weekend just gone, Chinese rival BYD slashed prices on several of its models in China. And that means that the difference now between the price tag on its vehicles versus those of Tesla's is very stark in that market. And then you also had the news that Tesla sales continue to slump in Europe. So they halved in April, according to the latest data. And given that came against the backdrop of quite meaningful growth in overall European EV sales, it kind of suggests that particularly, on the continent, the brand damage caused by what Elon Musk has been doing politically could be quite lasting. There's a few other sort of things, I suppose, counting against Tesla at the moment. I mean, it doesn't have any presence in hybrid vehicles, and I think we've seen that motorists are still quite wary of going fully electric. So hybrid has been, doing reasonably well in relative terms, and they don't have any presence there. And then I think there's been, a bit of a loss of patience on a failure to deliver on previous big promises about future innovations at Tesla, probably most notably on self-driving vehicles. Although I did see last week that there was a post on X from Musk that kind of raised expectations about an imminent launch here. He's talking about, how much time he'd be spending on the factory floor, and that's created some excitement. So I guess we'll wait and see if that translates into anything tangible.
Yeah, I think I spied something last week. It was very much sort of on in the background, but sort of vox pops, people being asked, would you get in a self-driven Uber or taxi or self-driven car? A self-driving car, I should say. So yeah, no, definitely something on in the background, clearly sparking a bit of interest in that space as well. And I wanted to ask you about Games Workshop next. Now, it's been a great year so far for this kind of Nottingham-based company, but shares were down, weren't they, following the earnings guidance update that saw a jump in profits? What's going on here, Tom? Why is that?
Yeah, so for those who aren't familiar with the company, I don't know whether you're a devotee, Charlene. I don't mean to assume, but I'm guessing that you're probably not.
No, I've seen plenty of them around, but no, I've never actually even been in one, so I am definitely not the expert here.
Yeah, I wouldn't call myself an expert either, but it's been a real success story on the stock market. So I do know the story from that point of view. And the business is basically underpinned by having this army of fans who are obsessed with the fantasy worlds it's created. They collect these miniature figures and paint them, and they play these board games or tabletop games they're sometimes called, that they've created. So what happened is, you're right, they came out with this trading update. Games Workshop typically comes out with quite short trading updates to the point, which is quite refreshing in some respects. But they did upgrade guidance for the current financial year that ends at the beginning of next month. But what they said at the same time was that the licensing revenue, which had reached a record level in the year to the 1st of June, wasn't going to be as high as that in the year that's about to start.
Right.
And the market loves these licensing revenues because essentially Games Workshop doesn't have to do anything. This is just kind of free money in a way, or certainly kind of easy money for the business. I mean, they're still talking about focusing on this area. And I think part of perhaps the disappointment is linked to the fact that there's been a huge excitement around the deal that the company has struck with Amazon. So Amazon's agreed to create a film and TV series based on its Warhammer 40,000 kind of universe, and has agreed creative guidelines for that. But I think these licensing revenues aren't going to come through for quite a long time. So, there might be a period where licensing revenue dips a little bit. Longer term, there is this potential from the deal with Amazon. And, I think obviously there was some disappointment on the day, but you could take the positive from it in the sense that the company sort of takes the integrity of its intellectual property pretty seriously, which it should do, because that's been very fundamental to its success, and it's not going to risk that by failing to be quite selective in where it agrees these licensing deals. Because if it licenses its kind of IP to something that then really alienates its fan base, that could have a really negative impact on future trading. So I think there's some sense in what they're doing here.
Yeah, sort of, we're talking about brand management with Tesla there. So it is, maybe being choosy about, like you say, how you place your name. Right. I think it's time for our first interview. We've got 2 for you today. Well, 2.5 really, if we include your chat with Ian. So in last week's show, we ran a snippet of an interview with Ian Lance, who's co-manager of the Temple Bar Investment Trust, about all what was going on with Marks and Spencer's. We're now going to hear the rest of that interview, where Dan Coatsworth talks to Ian about some of the best-known names on the UK stock market, including BP, Shell, and ITV. So let's hear what Ian had to say to Dan.
So I'm very pleased to be joined by Ian Lance, who's the co-manager of the Temple Bar Investment Trust. So Ian, great to see you. How are you doing?
Very good, Dan. Good to see you as well.
Yeah. Well, I wanted to start a conversation just by talking broadly about the UK stock market. I think it's quite interesting. At the time we were recording this, UK is definitely outperformed the US stock market this year. I'm wondering whether you thought, are we finally at the point where the UK loses its unloved status, and actually more people now get interested because they can see that, finally the UK is doing better than the US?
Yeah, I mean, we're definitely not at that point yet. If you look at the sort of fund flows, it's really depressing that every month we continue to see money coming out for UK equities, despite the fact that UK equities are, still incredibly cheap. And B, as you said yourself, actually have started to perform a bit better. I mean, last year I think Temple Bar was up about 20%, which is not bad. The UK market was up about 10%, so you can make good money in UK equities. This year, I think, is even more interesting because last year that was against a background in which the US did well. This year things seem to have really changed. So, I ran these figures yesterday. This is for a UK-based investor. Nasdaq down 7, S&P down 6. FTSE up 6, Hang Seng up 10, Euro stocks up 12, DAX up 20. So, there is definitely a feeling that things have changed. And what I hope, I suppose, is if that continues, then at long last, we actually might see people start to consider the UK as an investment choice.
I guess if people are kind of looking at all these tariffs and thinking, crikey, one, this might really hurt the US economy. Two, actually, there's plenty of stocks in the UK market which are less affected, or some might not even be affected at all. So I feel like there's a sense of people are looking at the UK, or particularly Europe, certainly things like Germany, that they're cheaper. It's perhaps it's time to stop being so dependent on the US for returns. Do you feel those are key sort of drivers?
I think we need to remind ourselves that the US got to the point where it was over 70% of the world stock market, and I think, given what's happened this year with Trump and tariffs and a dollar weakness, don't forget that if you're a UK-based investor, you are suffering not just from a declining US equity market, you're also losing on the currency as well. And I think that's caused people to basically look at their allocation and think maybe it is time to take some money out of the US and move it to other markets. I think I was just going to mention one other thing, Dan, which is actually, if you look within markets, it's an interesting shift going on there as well. So these are returns over the last 1 year. British Telecom up 75%. Who would have thought that? You could make 75% your British Telecom. NatWest up 70, Standard Chartered up 65, Direct Line up 55, Marks and Spencer's up 50. And then down the other end, some of the former sort of growth darlings, companies like Moderna, minus 75%, Estee Lauder, minus 60, Novo Nordisk, minus 50%. So, it feels like within the market as well, things have definitely shifted this year.
Is that like a sense that people are going to more value stocks? Clearly, the UK examples you mentioned, for a long time they were certainly cheap. I'm not sure what some of those US names. I'm sure like some of them must have been pretty expensive. Is it that growth to value rotation?
Yeah, definitely. There's definitely a growth to value rotation going on. I think if you ask yourselves what drove the outperformance of growth from sort of 2010 to 2020, we don't know for sure, do we? But it was probably things like low interest rates, quantitative easing, et cetera. And I think people have recognised that those things are probably gone. They're not coming back. And so we're in a very different environment today. And it would be crazy, therefore, to expect the stocks that performed in that old environment to be the stocks that led in the new environment. And I think there is a recognition of a need to switch from growth to value, particularly at a time when people, I think, can see how expensive some of those growth stocks still are versus how cheap some of these UK names are. I mean, again, I mentioned NatWest a couple of minutes ago. NatWest is up a little bit more than 100% in just over 12 months. It still trades on a price earnings ratio of 8, which is just crazy, isn't it? I think finally people are waking up to that. And I think, very briefly, two other things that I think people have realised is that, in actual fact, even if we don't see big flows into the UK, we're starting to see mechanisms that realise value. So we saw a whole load of takeovers last year that undoubtedly drove value. And then we saw lots of these companies like NatWest being a good example, buying back their own shares. And that was another thing which, drove value in the UK.
Yeah, I mean, obviously, on the subject of takeovers, there's quite a few names in the Temple Bar portfolio which have sort of been, subject to market speculation. One is BP, suggestions that Shell might want to buy, or someone else. What do you think? Actually, BP is a viable, or this is a plausible takeover target, or is it the people going, well, BP is looking a bit broken, therefore we just assume someone will pick it up?
No, I mean, obviously we never comment on specific rumours, but no, it absolutely is a plausible takeover target. Why? Because I think it has lost a lot of credibility with its poor strategic choices over the last 4 years. So I'm not sure to what extent people know this story, but basically of the big energy companies, it was the one that really decided to cut back on their core business, so cut back on oil and gas, and basically redeploy their resources into the transition. So, areas like renewables. And that was a pretty catastrophic strategy. And the former CEO, Bernard Looney, he basically paid for that with his job. And the new CEO, a chap called Murray Auchincloss, has begun to sort of move back in the other direction. So I think there's a sense amongst investors that they really lost their way and they really now need to start to deliver. And if they don't, I think patience is going to run out with them pretty quickly. They are smaller than a lot of the other big energy companies, so they're significantly smaller than Shell, but also significantly smaller than Chevron, Exxon, et cetera, et cetera. So there's that. They have higher financial gearing. They have a big activist shareholders. There's a US firm called Elliott has taken a 5% stake in BP, and they are very aggressively pushing them to change their strategy. So basically to take out costs, to just basically generate cash, buy back stock and pay dividends. And I think the company probably are in last chance salute. If they don't get this right, then absolutely they are going to find themselves vulnerable.
What do you think that the UK government could step in and block it? I guess could they cite energy security, or actually they have to accept this is a publicly quoted business and there's nothing they can do about that?
Well, I think so, but also one has to realise now that BP is quoted in London, but it's not particularly a UK business, is it? The majority of their profits come from overseas. It would also be slightly hypocritical of government, who are doing their best to try and shut down North Sea oil production, to then start talking about national security, wouldn't it? So it will be an interesting test case. But personally, I think the government would find it hard to block that one.
Yeah. Well, still on the subject of takeovers, ITV is another one. Now, there's not a suggestion that the whole of ITV might be bought, but certainly its studios arm. Obviously, I think for all the years that I've been looking at the stock market, I can't remember one where ITV wasn't cited as a bid target. What's different now, do you think?
Possibly what's different now is there is some consolidation going on within the studios industry. So ITV themselves, actually, they were looking at a company called All 3 Media, and they were eventually outbid by another company called Redbird IMI. So you basically they put those two businesses together as a studios business. There's another French company called Banijay, and I think there's an idea that in the sort of content production area, scale is becoming increasingly important. The budgets for lots of these things are pretty big, aren't they? And so I think there is a feeling that the studios are going to continue to consolidate. And that's probably what's driving some of these rumors. The thing that has always been the same is the valuation. So the studios business basically generated about 300 million of profits last year. Let's put that on 10 times, so that gets you to 3 billion. Well, that's greater than the market cap of the entire company today. So you'd be getting the broadcast business for free on that sort of valuation. So I think it's a combination of what's going on in the industry and the low valuation that is continuing to sort of produce these runes.
I guess if it did sell that bit, you'd be left with the broadcast bit. Is that the sort of the chunk of ITV actually investors don't really want? So would that obviously be like a bit of an unloved, and would be depressed?
Yes. I mean, I have to say, we personally don't want them to break the company up. We personally think that there is merit in keeping the two bits together. Partly because of what you've just said, is that I think that the broadcast business actually is underrated. They, the company that's embarked on a strategy, haven't they, to basically go from an analog to a digital world with the launch of ITVX and so on and so forth. And actually, to their credit, it's actually been pretty successful. ITVX now is growing very, very significantly. But nonetheless, you're right. I think without studios, it probably wouldn't be particularly highly valued by the stock market. That's why our preference really is to keep the businesses together.
Yeah. And just if we've seen UK stocks do quite well this year, you mentioned about names like NatWest have like delivered, and BT, gains that you would never imagine. What does that mean for you as a value investor? Does that mean your sort of opportunities now, they're much fewer? Have you actually found anything sort of new this year in terms of opportunities?
We have actually. Yeah, I mean, I suppose this is the, I'm doing air quotes here. This is the nice thing about the UK stock market being so cheap, is that there are plenty of cheap stocks, and you don't. I accept the argument that small cap is probably cheap. I don't disagree with that at all. But the interesting thing is we are able to find lots of large cap names that we think are very cheap. And so, to give you some examples over the last few weeks, we actually initiated a position in Burberry. At a quite fortuitous time, actually, because they had results this week and they jumped up pretty aggressively on the back of those results. So that was one. Another company is Smith and Nephew, the company who basically makes sort of knee replacements and so on and so forth. That's a company that have been struggling for a number of years. It looks like they are starting to turn the corner, and their share price got taken down during the sort of during the tariff fright. And then the final one is Johnson Matthey, actually. So Johnson Matthey is another company, a little bit like we were discussing with BP, where they sort of try to aggressively diversify away from their core business into transition areas. It didn't really work, and again, they are sort of pulling back from that. We feel like that they are now sort of turning a corner, and so that was another good example. So yeah, no, actually, it's been good. And I think the final thing I will add is that I mentioned earlier on how cheap NatWest is, and that's the same across a number of stocks within the portfolio. I.e., the share prices went up quite significantly last year, but the earnings are going up at the same rate. So because these companies are basically able to buy back their own shares at such low valuations, therefore what you're getting is the EPS and the DPS is going up pretty much in line with the share price, and therefore you're not really getting a re-rating yet. So that should be good for future returns. So we're quite optimistic at the moment.
Excellent. Well, Ian Lance from Temple Bar Investment Trust, thank you very much for coming on the show. Brilliant to talk to you.
Pleasure.
Thanks to Ian for a second segment on the show here, getting maximum value from him there. So whilst we're talking about UK listed investments, there's been talk from a fund manager, I hear, about the London Stock Exchange Group itself. In what could be the kind of ultimate indignity for the London market, he's suggested that the group might be seeking a listing outside of the UK. I'm going to hand over to Tom and Shares Deputy Editor Ian Conway to discuss this further.
So we're talking today about the London Stock Exchange Group, with emphasis on the group. As we're about to find out, it's much more than just a stock exchange. However, it would still be pretty damning if the owner of the London Stock Exchange was to take its listing elsewhere, but that's just what one fund manager suggested it might consider doing, and at the same time ditching the exchange business altogether. So more on that later. But first of all, Ian, could you maybe talk us through the business as it stands today?
Hi, Tom. Yeah. As you say, from the name London Stock Exchange Group, you would think that's mostly what it does. But actually, in 2021, it took over Refinitiv, a big deal, $27 billion. And now half the revenue pretty much every year comes from data and analytics. And then recently signed a deal with Microsoft. So it's become more of a data and analytics business than a stock exchange business. Only about 20% of the revenues come from trading. And probably of that, only half comes from the London Stock Exchange itself through trading fees and listing fees. So you've got this huge data business, and so it generates, out of annual revenue of 8.2 billion last year, 4 billion fully came from the Refinitiv business. And it also owns the index provider, the one FTSE, Financial Times Stock Exchange, FTSE Russell. That generates about 10% of the revenue. And it's like S&P Global in the States. So if you want to use a benchmark, you have to pay FTSE you have to pay the LSE group for the privilege of using it. Then there's about 15% of the revenue comes from post-trade and settlement and clearing. That includes LCH, London Clearing House. So member firms and non-member firms have to pay clearing fees every year. That's a really profitable business, and so makes up about 15% of revenues. And then the last 5% or so is from the risk intelligence business, which is quite new, and that's all about providing solutions against financial crime and fraud. So it's quite a broad group of businesses altogether.
Yeah, absolutely. And how are those businesses performing right now?
Yeah, I mean, it had a good year last year. Something like well, it's like 8.2 billion in revenue, and this year, the first quarter, I think group revenue was up something like just under 9%. But funnily enough, the best performing business was the markets business, which includes the LSE. The revenue was up like 13.5%. That little risk intelligence business is growing fast. That was up over 10%. And actually, the data and analytics, which is what they spent all that money on, grew about 5% in the first quarter. It was an improvement on the last quarter of last year. They're looking for growth overall of about 6.5%-7% in revenue this year. But they're buying back £500 million worth of shares. So actually that will have an impact on earnings per share. Earnings per share will grow faster than the top line because they're buying in shares. They're about halfway through that at the moment.
Yeah, that makes sense. I mean, in terms, that obviously covers the short-term performance. I suppose one of the reasons, and I'm just about to sort of come on to this, but that, there might be a push to focus more on data and analytics and perhaps on the kind of index provider business is that those businesses have much higher levels of recurring revenue, don't they? So I guess there's more visibility in terms of that revenue stream.
Yes, and I think the sense is that a data and analytics business should have a higher rating than a business which is associated with the stock exchange. And there is this sense that if the UK market's doing well, then the LSE group is doing well, and if the UK isn't doing well, then the group isn't doing well. It's only 10% of its revenue.
Yeah.
So I can kind of see the argument.
Yeah, and so this argument has sort of principally been put forward by a fund manager called Stephen Yu, who manages the £1.2 billion Blue Whale Growth Fund. And he recently raised his holding in London Stock Exchange Group from around 1% of the fund to somewhere around 3%. And what he's suggesting, as I sort of outlined a little bit or intimated at the start, is that the company should spin off the stock exchange business, kind of effectively divest, demerge that, and then move the new entity, move the shares in the new entity to New York, where he thinks they could get a better rating as a kind of pure play data firm, as you were just kind of referring to there. Now, obviously if it did that, you would think it would change its name, because it wouldn't make any sense for it to be called London Stock Exchange Group if it had nothing to do with the stock exchange itself. How, a stock exchange provider would fare as a kind of an independent entity, or what parts of the business exactly it might divest, is open to question. And as you point out, it's not just the exchange. There's the clearinghouse business. There's other bits of the business that aren't data and analytics, but perhaps have a different dynamic to the stock exchange business. I mean, this comes back to a whole argument, and it kind of feels quite sensitive probably for London Stock Exchange Group, because there's long been an argument that by moving your listing away from the UK, you can get a higher rating. So, you get a higher valuation than you would if your shares are trading in London. But actually, looking at sort of some of the current forecasts, London Stock Exchange Group is on a roughly similar earnings price to earnings ratio as, I guess one of the main lookalikes for it in the US, which is S&P Global. So both roughly around 20 times earnings. So that suggests that it might not make an enormous difference if it was to move to the US. And particularly given actually some of its returns and its margins are a little bit south of where S&P Global are. So yeah, it's an interesting suggestion, and I guess it will raise some eyebrows given what that would potentially say about the London market if the operator of the stock exchange was to both sell that business and then up sticks and move to the US. But I know the chief executive, David Schwimmer, has kind of played down, generally the impact it can have if you move over to the US.
Yeah, he hasn't actually responded to this this suggestion that the LSE move its listing, but what he has done is he's played down the talk of companies moving to the US and getting some kind of benefit from that. The problem is that, ironically, the big criticism of Schwimmer of late has been he's paid too little attention to the UK business, the stock exchange, because last year there were just 18 new listings, which is the lowest number since 2010, and 88 companies did move or delisted. So he's kind of on a sticky wicket here. I mean, it's interesting. Stephen Hughes is quite punchy. So he's saying, basically, shareholders in LSE Group don't care about the stock exchange. They'd be quite happy. They don't really want that bit of the business. He suggested that Euronext, which is a French-listed competitor, so Benelux and France operator, or Deutsche Börse, which is listed in Germany, and has tried before to buy the stock exchange. He suggested those guys would be ready buyers. They get a good price for it, and it's only sentimental reasons that a national pride that LSE Group is holding on to it. But you've hit the nail on the head, really, Tom, because S&P Global is trading on pretty much the same rating that LSE Group's on now. There's no guarantee that moving to the States is going to increase the rating. In fact, we've seen with a few firms it hasn't really made a great deal of difference. So it's an interesting discussion. It's an interesting idea. Funnily enough, if you look at the share price of LSE Group over the last 5 years, people have been, I think twice in the last 5 years. The other thing is that in the AGM in April, investors have vetoed his pay increase, because they don't think he's doing a great job. And they're saying, and that's twice over 5 years that's happened. Well, over the last 5 years, the shares have actually matched the FTSE. They haven't done any better than the FTSE, but it maybe that just confirms the fact that people think of it in terms of the UK stock market. It's up 45%. The evolution of it's quite different. It's a flatlined until 2004 and then took off, whereas the FTSE has actually been very, very steady performer from the lows of 2020. But maybe there is some truth to the fact that the stock exchange share price does tend to move as people think UK market's doing.
Yeah, that's interesting and a good point. And like you said, the fact that much of the increase in the LSE Group has been since the start of last year. It's not, before that it was pretty moribund, really. So yeah, it's hard to say. I think it's important to say this is just a suggestion from a fund manager. There's no suggestion, or there's been no suggestion from the company they're considering this at the moment. But you wouldn't rule anything out, I suppose, either. And, you made the observation that there would be potentially some willing buyers for the stock exchange business. And, it's certainly been the case that there have been rumours in the past, haven't there, that, certainly I remember the Deutsche Börse being, flagged as a potential acquirer of that business. And in fact, went some way down the road to doing so, right?
Yeah, and there's a perfectly valid argument for businesses finding the right owners. I noticed today Rentokil, for example, selling off the French workwear business. To me, that never really made much sense why they own that business. I'm pleased to see they've got rid of it. Businesses, I think, I'm sure Deutsche Börse or Euronext will do a very good job of managing London Stock Exchange. I'm sure there'd be lots of synergies. 2 + 2 could equal 5, let's say. But you're right. We come back to as you said right at the beginning, what would it say about the UK market that LSE Group is selling off the LSE? It's a tricky one.
Thanks, guys. Some great insight there. And now to something a little bit more personal finance and planning for retirement. So I spoke to Pete Matthew, who's a financial planner and also host of the Meaningful Money podcast, about his new book. It's all about making sense of your finances as you approach retirement and, crucially, how to make that money last. So joining me on the show today is Pete Matthew. Now, Pete runs a financial planning firm based down in Penzance and is a bit of a legend in financial planning and advice circles. But he has spent over 15 years also creating content to help people take control of their own personal finances through meaningfulmoney.tv. So as well as articles and one of the original personal finance podcasts, he has put together his wisdom down in print with not one, but 2 books. And his second book, The Meaningful Money Retirement Guide, was published earlier this month. So I've asked Pete to come on the show to talk retirement and how people might want to approach managing their money in the run-up to it. So hi, Pete, and welcome to the AJ Bell Money and Markets podcast.
Thank you so much, Charlene. Legend. I'll take that. That's excellent stroking of my ego right at the start. But I'm very grateful.
Very welcome.
That was very kind.
You're very welcome. So congratulations on the new book. Now, retirement planning is a huge financial topic and can be quite overwhelming to even begin to contemplate for people. So kind of to help people get cracking, you've broken it down into 3 distinct phases. Can you briefly tell us what these 3 phases are before we delve a bit deeper into the first one?
Sure. And this has really just come about from having done my job as a financial planner for sort of 27 years. And most people tend to present to us as advisors in the first of the 3 stages, which I'd like to call the home straight. So a sort of loose athletics race analogy, if you like, you're sort of rounding the final bend. You can see the finishing tape in front of you, and it's like the last dash to the line, mostly because that's very often when we might be free or freer of children. If we've had kids, we may be getting towards the end of our mortgage or have paid it off. We may be at the peak of our earnings powers, so we can really sort of hit the gas and really try and sort of get to that finish line in as strong a position as possible. So the first stage I call the home straight. And then there is the what I call a great transition. So all kinds of mixing metaphors here. But the great transition is really, for most of us, retirement is not a point in time. Very often it's a process over sometimes a number of years. We might slow down, do 4 days, 3 days a week, or shift into a role which is a lot less stressful, so we can kind of ease into retirement. And maybe we have pensions kicking in at different times, and so it's more of a transition than a sort of cliff edge, if you like. And then sort of phase 3 is what I call the sort of new normal. And really shifting into retirement is a big deal. It's a big emotional, psychological event, I think. And so much of our kind of identity is tied up in what we do for a living. So take that away and we have to kind of find a new place in the world very often. But life does tend to settle down, give it sort of 2, 3, 5 years into retirement, and we're in a nice rhythm. It's very different from our working life sort of pattern, but we're in a nice rhythm. Spending tends to settle down. We're having the holidays that we want or whatever. And that's nice and comfortable and easy until it isn't, because inevitably our bodies sort of start to pack up, and maybe our minds too. And we start to think about the end game, really. So we've got the home straight, we've got the transition into retirement, the great transition, and then the new normal, which is the sort of the last act, if you like.
Yeah, absolutely. So as we've got kind of limited time today, sure, as I said, I'd like to concentrate on the home straight if we can. Sure. So I think, as you've mentioned, obviously your career as a financial planner, and a really important part of that is asking key questions to kind of help discover what makes people tick and what they want to achieve, so that you can figure out whether you can help them. So for people managing their own finances, what would you say is sort of the one key question or key questions that they should be asking themselves in this kind of home straight phase?
Sure. I'll sort of come back to this, like, practicalities of it in a minute, but really the whole point of this, the whole reason we're working and we're saving and investing for the future is to not have to work one day. I would argue most of us, that's the goal, or at least not to have to work, right? And even if we choose to work, and many of us are increasingly fairly deep into retirement doing some kind of meaningful work, whether it's paid or not, it's about not having to work to pay the bills. Essentially, we have achieved financial independence. But the question is always, to what end, right? So why are we doing this? Why are we saving? Why are we, foregoing perhaps some pleasure today to store money into our pensions for when we retire? What it should be is about what really lights you up, whether that's travel, whether it's having the freedom to give of your resources, time, energy, money to the people or the causes that you care about. So what would a really great day look like if you didn't have to work? These would be the sort of questions I'd be asking myself if I wasn't working with a decent financial planner, because money is only ever a means to an end. It's never a tool in itself. The goal should never be simply to amass more money. It should be, we need to have enough to live a really great life that where we can get to our sort of deathbed and be really happy with no regrets. So that's the sort of stuff I would be asking. What's truly important? What does a great day look like? Who do I want to be with? Where do I want to be? What am I eating and drinking? And ask these sort of qualitative questions rather, because then we can work back to the numbers and work out whether we've got enough or not.
Yeah, absolutely. I love that phrase, financial independence. So, you're choosing to work because actually you might enjoy it or you're winding down, but it's not because you have to. Onto kind of a bit more of the practicality, like you mentioned. So, as a firm, we talk a lot about combining pensions, particularly in this kind of home straight as a starting point. And that's just a small part of the puzzle, though. Kind of what would you say are your top practical tips for people in this, what you call like a positioning phase?
Yeah. Okay. So combining pensions is a key part of it, because one thing I think will help anybody engage better with their finances is if they are simplified. Okay. So these days, I don't know what the average is, but something like 6 or 7 or 8 jobs throughout our career, very often more than that.
Yeah.
Each one of them will come with a pension. Right. And so what we often do is we leave one company and we start working for another one, and we kind of freeze that pension and leave it there and forget about it. And so in the home straight, this sort of 5-10 year run up to retirement, the key thing is to know what you've got. And most of us don't. And most of us have no idea what it's really going to amount to when we start taking money out, when we retire one day. And so we've got to know what we've got. And that takes a bit of work, right? It takes a bit of detective work. But again, it's not going to do itself. So there's a ton of practical stuff in the book, the kind of questions you need to be asking, looking for your most recent statement from your pensions. If it's more than a year old, then maybe they haven't got your address, or maybe you haven't registered for a portal or something. And so it gives you very clear steps as to what to do and what to ask your providers for, pensions and just non-pension investments like ISAs and general investment accounts and stuff. Once you know what you've got, you can look to simplify and tidy, because when it comes to taking money out one day, having multiple pots is only going to complicate that as well. And that, I don't know about you, Charlene, but the last thing I want to be doing when I'm retired is spending like 5 hours a week managing my money, right? I want to do that in 5 hours a year, if at most, okay? So I think if we can spend the time simplifying things in this run up to retirement, it has all kinds of benefits. Very often it will reduce costs, right? Some old plans are more highly charged. And if there's one of the few levers that we actually have in our control, is the costs we pay for our platforms, for our funds, for our advice. So we need to make sure we're not paying over the odds. Simplifying and combining can sometimes reduce those costs. It enables, I think, better engagement. Because you might think, right, wake up on a Saturday morning or whatever, right, today is the day I'm going to sort my pensions out. And then you pick up your stack of envelopes with statements in it, and you just think, you know what? I can think of about 500 things I would rather do than this right now. Whereas if you've only got one pension to get on top of, and you've already kind of, I encourage people to almost put like a cover sheet on the file. It's like, provider, policy number, how much it's worth, how much I'm putting in, how it's invested, what it's going to, that sort of thing. Just do the pre-work to simplify. I think that can only help.
Excellent. Thank you. And when we're talking about pensions. Obviously, we're 10 years on now from quite a monumental change, what's known as pension freedoms. How has that impacted how you deal with people, how you help them plan their finances? Obviously, that means it's been great for kind of what we call freedom and choice. There's lots of choice for people out there. But has that also worked to maybe confuse people with all the options out there?
Yeah, potentially. With more options comes, again, more sort of inertia, because you're just like looking from side to side and say, I don't know which to pick, so I'm going to pick none and come back to it in a year's time. So obviously, I mean, this is our bread and butter day to day as a financial planner, is sort of doing this for our clients. But actually, I think people can do this themselves. I've always said that if there's one point in life where working with a decent financial planner will benefit you, it's this sort of run up to retirement, right? But anybody with the will and a bit of time can do this stuff themselves. So we found the pension freedoms are undeniably a good thing. Do you remember all the sort of concerns that people would take out all their pension fund and blow it on a Lamborghini? Remember that? That was in the press at the time. I mean, that's just not happened. One thing that people don't change, if they've got themselves in a position where they can retire well, they don't suddenly become spendthrifts and blow their money on stuff they don't need. Instead, the kind of flexibility and the options that are available to you now allow you, I think, to craft a retirement which works with what your goals are. There are fewer limitations. So, for example, some of us might have pensions kicking in at different times. So obviously we've got the state pension at 66 or 67, depending on how old we are. And maybe we've got an old final salary pension from a company we worked for 20 years ago, and that kicks in at 60. And maybe there's another one at 65. And so we end up with different sort of incomes kicking in at various times. And we can use the pension freedoms, being able to dip into our pension in all kinds of ways. We can use that to kind of fill in the gaps with our other pensions, to do that as tax efficiently as we can using tax-free cash, or maybe OFF Plus, which is a terrible acronym, but it's one way of taking money out of a pension. And so it enables us to kind of design an ideal retirement. And that's essentially the crux of the book. It's like, look, you need to know what these options are. So I'll always sort of explain them so that then you can understand how best to use them to your advantage. It's what I do every day, but I don't think it's rocket science. I think it just requires people to spend a bit of time learning about it. And the goal of the book is to give them everything they need to know and do to sort this out for themselves. So yeah, I think it's undeniably a good thing, the pensions freedoms. It's not led to negative outcomes. I guess the only thing is you need to, it puts the responsibility on the individual to make sure that what they've got lasts. But that's doable with a bit of care and a bit of thought.
Yeah, and just keeping an eye on things like tax, as you've mentioned as well. Sure. And kind of on the show, we talk about a lot about what some of our customers are up to and trends like that. I kind of really like to ask you, in terms of your experience, your podcast, what you get asked day to day by people. What's your kind of top one or two questions that you get asked?
The things I get asked about are very often the things that move the needle the least. So, for example, how people should invest inside their pensions. Okay. You know, should I have 5 or 10% allocated to emerging markets? My answer is it doesn't matter in the grand scheme of things. Yes, it will make a slight difference, but it's not going to make or break the plan. Things that will really make a difference are costs and tax, the amount you spend, and the time that you spend it. By that, I mean, what you don't want to do is to be selling down assets in anger when they are distressed. So if the markets are down for whatever reason, we've had a pretty rocky few weeks prior to recording this. If the markets are down, you don't want to be drawing heavily off your investments, because anything you take out can't, by definition, recover. And so one thing we do here at my practice at Jackson's, and which I describe in the book, is building something called a cash flow ladder, where the money you need in the very near term isn't at risk at all. It's not invested, it's in cash, because that means you are sort of protected from the ups and downs of the market, and money you're not going to need to spend for 10, 11 years, you can largely forget about and really push that hard and have it grow. So what I get asked is the stuff that doesn't really matter, weirdly. But the thing that I continually labor on is costs and tax, the sort of timing of your withdrawals, and then how much you spend. Yeah, that's really the biggest lever under your control, is spending. And so that's what you've got to work on. Another thing, sorry if you forgive me, that I asked quite a bit, which I think it's worth mentioning, is people say, like, let's say they've got a lump sum to invest for whatever reason. Should I put it all in, or should I drip it into the market? I get that asked all the time. So if you got, I don't know, say 50,000 or 100,000 to invest, let's say it's an inheritance, it's a lump sum come to you. Should you just stick it all in your investment straight away and get it working, or is it worth dripping it? And you look back at almost every single study historically, the best outcome is that you put it all in one go. But that can feel like quite a big step, particularly if markets are volatile. What if I put it all in and the market falls 20% further? And so putting it in over a matter of weeks or months is a kind of psychological crutch. But either way, it's a toss of a coin. You'll either be glad you put it all in one go, or you'll wish you had. And the only way to know that is in reverse, right? Is looking behind you. So that's another thing not to obsess too much about. But if it helps you to sleep a little bit better, then drip it in. But don't do it over like a year. Do it over like 6 weeks. Just get it in and just do it sort of slowly. So that I get asked about all the time. But again, it won't make that much of a difference.
Oh, that's really interesting. Well, thank you for sharing that. And thank you so much for coming on the show, Pete. It's been a really great chat. I've really enjoyed it. And I wish you all the best with the new book.
Thank you very much, Charlene. Thanks for having me.
That's it from us this week. There's plenty going on, and I'm sure there'll be no shortage of stories on the horizon either.
As always, thanks for tuning in. Now, please don't forget to hit follow or subscribe on your podcast app so you never miss an episode. You might have heard we also film every episode now for both YouTube and Spotify podcasts, if watching an episode is more your thing. And of course, if you're enjoying the show, we'd love a quick rating or review. It really does help.
We'll be back next week with more on the markets, money, and what it all means for you. And take care in the meantime.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.